The signal we've been waiting for just hit. On Wednesday, the Federal Reserve made a move that will reshape the markets heading into 2026. Welcome back to the Richard and Chloe A.I. investing channel. The Fed delivered its third 25 basis point rate cut of the year, lowering rates to 3.5 to 3.75%. But the bigger news is this. The Fed will start buying $40 billion a month in short-term Treasury bills beginning December 12th. That means new liquidity is flowing into the system, a clear pivot toward easing. And the market reacted instantly. The Russell 2000 jumped over 1.3%. The Dow climbed more than 1%. The S&P pushed toward new all-time highs. Volatility fell, and the U.S. dollar weakened. Commodities confirmed the shift. Silver, copper, oil, natural gas, and gold all moved higher. The bond market agreed as yields dropped across the curve. And here's what matters. Rate cuts and liquidity injections hit the real economy months later. So the impact of these moves is aimed squarely at 2026. And the rotation has already started. Energy surged nearly 5%. Industrials and basic materials jumped. Financials and consumer cyclicals followed. Meanwhile, defensive stocks barely moved and mega-cap tech cooled off. This is classic early cycle repositioning. Crypto behaved exactly as expected. Bitcoin held firm. Ethereum stayed green. Staked ETH inflows continued rising, a sign of confidence. Now, let's break down what this means in simple terms. When rates fall and liquidity rises, the economy speeds up. Manufacturing improves, construction expands, housing strengthens, banks lend more, and companies invest again. So here's where money is rotating into as 2026 heats up. Energy. Demand rises in growing economies. Industrials, construction and manufacturing accelerate. Basic materials, copper, steel, and chemicals benefit from new building. Financials, lower rates drive loan growth. Home builders, cheaper mortgages boost demand. AI infrastructure, companies supplying chips, hardware, and systems behind AI. Ethereum, gold, and silver, assets that thrive on liquidity and a weaker dollar. And here's what investors are rotating out of. Consumer defensives and staples. Essentials grow slowly when the economy strengthens. Weak REITs. High-debt real estate funds struggle. Over-leveraged companies. Too much debt becomes a drag. Low-volatility ETFs. Built for safety, not early cycle growth. The bottom line? The Fed didn't just cut rates. They turned the liquidity tap back on. The rotation is underway. And the setup for 2026 is gaining momentum fast. If this helped you stay ahead of the markets, hit like, tap subscribe, and share. And tell me which sector you want to break down in episode 9. And remember, stay ready, because the market rewards those who move first.